Good morning, I'm Lizzie Burden in for Vonnie Quinn with your Bloomberg Brief. Here's what you need to know. A futures outage at the Chicago Mercantile Exchange disrupts trading across global markets. President Trump, meanwhile, calls for a series of potential measures to crack down on immigration following the shooting in Washington. And the holiday season shopping kicks into high gear for retailers and consumers, but consumers showing signs of fatigue. Well, let's get a check on these markets. It was always going to be a quiet one this Black Friday, and it's even more quiet because of this CME outage. So in the absence of S&P futures, we have to look to ETFs. But the indication is that we are going to have stocks continuing higher in today's session. Flip the board over and you can already see what's happening in the European session. In short, a whole lot of nothing. You've got Stock 600 flat to the downside there. The FTSE 100 managing to eke out gains. Euro dollar there at a 116 handle, weaker after that French inflation data unexpectedly held steady. We had Spanish CPI staying strong. And we keep an eye, of course, on the 10-year gilt yield as traders continue to digest that UK budget, currently at 4.44%. But let's get into some of the stocks to watch this morning. Here's Chloe Melly.
Good morning, Lizzie. Let's start with Oracle, which is down today after Morgan Stanley analysts warned that a gauge of risk on Oracle's debt had reached a 3-year high, and that is probably only going to get worse in 2026, they said, unless Oracle manages to reassure investors that are currently quite worried about this massive AI spending spree, and therefore we are down about 1.3% for Oracle this morning. Moving on to SanDisk, and it is the first day of trading on the S&P 500 for that memory card maker, and it's a pretty good day. We're up almost 6% this morning. A lot of that has to do with a report that the US and Japan are considering a memory chip plant in which SanDisk would be a major investor, and so we're up this morning for that company. And finally, of course, CME Group seeing a little bit of weakness this morning on the back of that CME outage, which has disrupted markets across equities, FX, and everything else, and has really frustrated investors, and we can see that reflected in some weakness for that stock, that CME Group stock.
All right, thank you, Chloe. And coming up this hour, BNY strategist Geoffrey Yu on the markets, and we'll hear from Freya Beamish as well, Chief Economist at TS Lombard. But as you say, Chloe, trading of futures and options on the CME, the Chicago Mercantile Exchange, have been halted for several hours due to a data center glitch. Bloomberg's Kriti Gupta joins us now to explain. And Kriti, I feel like on your last day in London, this is the perfect story for you. We get to talk about the plumbing. Just walk us through the ripple effects of this glitch.
Yeah, you and everyone know I love a little exchange drama here. This one's really interesting. I mean, the argument is this the good day to have a problem like this or a bad day to have a problem like this? Let me walk you through it. Basically, what you're seeing is that the Chicago Mercantile Exchange, which, by the way, is traditionally known, what we traditionally associated with is commodity contracts coming out of Chicago, so things around cattle, wheat, etc. Well, they also do a lot with options and futures contracts, things that help the international audience actually trade American contracts, whether it's early S&P 500 E-mini futures, whether it's NASDAQ futures. So basically, while the U.S. markets are closed, how do you trade U.S. assets? Turns out this is the exchange that runs a lot of them. A data center that they rely on, operated by Cyrus One, seems to be having a technical glitch. They've called it and referenced a cooling issue that is in the works they are trying to solve. But, Lizzie, we are now at hour 7, hour 8 of this outage, something that is, to your point, affecting pricing. Traders around the world flying a little bit blind. But again, here's the good news. The good news is it's the day after Thanksgiving in the States. It's light volume. A lot of people who are trading or positioning around any kind of risk events going into the holiday probably did it before or will do it after everyone comes back to the desk. The bad side of that is that when the U.S. markets open, if you do see some sort of bigger risk event between now and 9:30 a.m. Eastern, there may be a little bit of a shock factor when those markets do open.
All right, Bloomberg's Kriti Gupta walking us through the plumbing. We thank you so much. And as we say, stocks losing momentum on the final trading day of the month, despite the growing bets on a December rate cut by the Federal Reserve. Geoffrey Yu, senior strategist of EMEA markets at BNY, has written, despite indications that both equity and bond returns look to set to end the month on a positive note, there is a clear safety bias in play. And Geoffrey joins us now. Good to see you, Jeff.
Thank you.
Chrissy just set out everything that's going on with the CME outage. I wonder if you expect to see disruption. Usually we'd be talking about positioning into December.
So it's interesting, and I would agree with the notion that it's actually a good day to have something like this on top of the holiday-related positioning she mentioned. It's also month end. We've had sort of a later Thanksgiving for this year. So in a risk context, what month end rebalancing you were looking at, people probably would have done that already. Or if you had a month-end bias, wherever futures would have pointed to an opening, your direction was probably set anyway, because there wasn't any other sort of market-moving news and for you to adjust month-end. So right now we're doing the best for our clients. It's BAU. Some talk of that on the trading desk this morning, but again, focus is for our clients.
All right, and I've got to talk to you about the UK budget, because the last time we were sat together on set, do you remember the Chancellor was rolling the pitch to raise income tax? Of course, she U-turned on that. But let's just talk about the market reaction to this budget. I'm looking at the 10-year gilt yield now, flat as a pancake, 4.44%.
Right.
The market was a bit nonchalant, shall we say, initially. Do you expect this focus on the headroom to pivot and actually for traders to focus more on the backloading of the fiscal consolidation at some stage?
So at some stage, yes, but actually that was sort of the talk throughout the day as well after the initial, slightly earlier than expected release of the headlines as well. But one thing I will say about gilts, though, still probably biased towards a more positive outlook for gilts, mostly because positioning heading into that was relatively flat. One thing that I'm keen on over the medium to longer term, and here's where the BOE's QT operations, comes into it as well, is the maturity breakdown. We know that the UK has traditionally had a very long maturity profile, and that was seen as a strength. But now the market's demand for that, not just in the UK, but globally, has softened somewhat. We've seen that in our own flow data as well, reduction in maturity exposures. So from the DMO's point of view, I was actually a bit more focused on that, where the distribution is going to be a bit more focused on the front end. I think this is something the market will have to absorb over time.
I mean, you mentioned the Bank of England. The budget did less to fight inflation than was expected in the weeks running up to it. For example, lifting the minimum wage. Does it change your view on BOE cuts?
I think the market pricing for the BOE is still a tad more towards the conservative side, and I mean that I think the BOE can actually do more next year because I think the OBR's projections actually had 3.5% as sort of their baseline. I think we can actually go below that 3.25. I'm not even ruling out 3. Now, on the plus side for the Chancellor is if that shifts not just the front end but the entire curve lower, and if they're going to issue more on front end anyway, it may save a bit more in terms of interest and costs.
Should like the sound of that.
Indeed, but overall the data is pointing to softness, and when we saw French inflation data this morning, German retail sales, so the German data waiting for that too. All over Europe, it seems, household demand is softening, notwithstanding the strong wage gains, and I think that's going to support the case for further easing.
But if Reeves has allowed these BOE cuts to happen, and maybe more, in your view, what's the upside left for cable?
Well, I think cable, from the whole market's point of view, why cable didn't react more negatively heading into this was because everyone was sort of bearishly positioned. I would say from cable's point of view, you're sort of running up against more of a dollar view at that point. So given our view on the dollar, is the dollar that easy to buy at this point? I think you have to match the two together. But in terms of relative value, we're looking at sterling against CAD, sterling against Aussie. I think this is where sterling may underperform a bit. Yeah.
And for the Fed, is it a choice between December and January?
I think the market's looking at December now. I know we've been on a bit of a roller coaster, but the positionings are shifted towards that. I think it's heading into next year. For December, how do you actually communicate the views heading into next year? What's the pace? And again, what's the labour market going to look like? That's what we're zeroing in on, especially as data starts to come through again.
Well, speaking of the views, of course, the market reaction to Kevin Hassett being the front runner, apparently, to be Fed chair was not crazy, actually positive. Do you have no concerns there? Does the market have no concerns about Fed independence under his leadership?
I think the market's just looking at central bank independence versus the fiscal concerns in general right now. So, we've had speeches from plenty of finance ministers globally regarding, where they feel rates need to be. So this isn't new at all. I'm looking at Central Eastern Europe, for example, where the language, the pushback, I would say, from the central banks is actually a bit more strident. And this is an area where we've sort of been positive in terms of positioning. So how to manage that? I'm hearing fiscal dominance, this phrase, coming through more and more. And I think that is going to be a crucial theme for asset allocation next year, especially fixed income markets, how they manage their bond portfolios.
Just finally, Jeff, if Fed cuts are priced in, what drives a tech Santa rally?
Well, a tech Santa rally, I think it will be earnings, it would be data, and overall, given that, as mentioned, a safety bias, we saw that across markets in November, simply positioning for no new news, both on the individual corporate side and on the policy side. I think that's more than enough for a brief rally, given how the market's positioning beforehand.
Do you know what? I'm not sure it's going to be a quiet December, but we'll see. Jeff, thank you so much. Geoff Yu of BNY, always good to see you. Well, now to some other top stories trending on the terminal this morning. The Zara chairwoman, Marta Ortega, is trying to push the retailer into the rarefied world of high fashion, nudging it away from the fast fashion industry that it spawned. Zara's winning fast fashion model still underpins it as Shein and Temu reshape the $1.8 trillion global apparel industry. Ortega's eyeing a sweet spot with haute couture brands hiking prices to stratospheric levels. Elsewhere, Russian President Vladimir Putin said that President Trump's proposals for ending the war in Ukraine could be the basis for future agreements. Putin said that the 28-point plan was rearranged into 4 parts by Ukraine and the US during the talks in Geneva, which can be the ground for talks. According to reports, the Kremlin will be discussing the peace plan next week. And Hong Kong's deadliest fire in nearly 8 decades has killed at least 128. The status of roughly 200 residents remains uncertain. Authorities have arrested 5 people linked to the estate's renovation project. According to the Labour Department, inspections had been flagging risks well before the disaster. Well, those are some of the top stories trending on the terminal. But coming up on the programme, President Trump calling for a permanent pause on migration from, quote, all third world countries. We'll bring you the details on that latest immigration crackdown next. This is Bloomberg. This is Bloomberg Brief. I'm Lizzie Burden in London. Well, President Trump says that he'll, quote, permanently pause migration from third world countries. In a lengthy post on Truth Social, he said that anyone who is not a net asset to the United States would be removed. It follows the death of National Guard member Sarah Beckstrom, who was shot near the White House by a suspected Afghan national. A second guard, who was also shot, remains in a critical condition. Well, we can get the details now with Bloomberg's Alexander Pearson, who joins me now. Alex, good morning. Just walk us through the specifics here, particularly wondering the definition of third world in this context and how quickly these measures can be implemented.
Good morning. Yes, that's a question actually a lot of us are asking this morning after we saw this Truth Social post from President Trump several hours ago. As you said, he has announced a policy of stopping all migration from all, as he puts it, third world countries. But he did not in that post define which countries actually meet that criteria. So it's unclear right now who would actually be affected, what the kind of impact on migration flows would be of that kind of ban. And so we would really be waiting for a proclamation that would, list these countries and then also what kind of legal path forward the Trump administration would seek to try and implement the ban. So it's unclear how quickly he could move ahead on that, although he might be able to move quite quickly if he implemented it in a similar way to his travel bans of the past. And then in terms of the other policies he announced,
Well, I wanted to ask you, Alex, how this will affect the labour market, because, of course, this has economic context.
Absolutely. I mean, migrants from developing countries, if that's what he meant by that term, tend to be lower skilled. And certainly if this were to be implemented and affect migration flows of lower skilled workers to the US, that could certainly have some impact on the labor market. We already saw some of that impact this year in terms of, causing labor shortages in sectors like agriculture and hospitality.
Alex, thank you so much for the latest there. Bloomberg's Alexander Pearson on that Trump's Truth Social post. Well, retailers are heading into this holiday season looking to attract budget-conscious shoppers amid continuing inflation and tariff pressures. Bloomberg's Romain Bostick sat down with the Bloomingdale's CEO Olivier Bron and the Burberry CEO Joshua Schulman to get their expectations ahead of the holiday shopping season.
'Tis the season for holiday shopping, and despite U.S. inflation holding above historical averages for 4 years and tariff tumult upending global supply chains for the past 5, the CEO of Bloomingdale's, he says consumers are ready to spend.
Actually cautiously optimistic. The trend over the past few months has been amazing at Bloomingdale's. We feel pretty strong about our customers' feedbacks, about our partner feedback, about the current trend that we're experiencing, and we're building such a great event for this holiday season that we're convinced that it will resonate very, very well with the customer.
And he's not kidding. Bloomingdale's is betting big on the holiday season, from personalized stockings to a Labubu tree and even a visit from a very familiar face. All in an effort to reinvigorate the department store shopping experience with emphasis on experience.
This is what we're refocusing on right now, is bringing experiences. Not only great products, but really bringing experiences that create the conditions of relationship. People want to connect, and we want them to connect at Bloomingdale's.
The Bloomingdale's flagship store on the east side of Manhattan has for decades been one of the crown jewels of New York City retail. But behind that grand facade was a company struggling to adapt to the times. Now, after years of sales declines, Bloomingdale's, a division of parent company Macy's, has found its stride, posting 4 consecutive quarters of same-store sales growth heading into this holiday season. And Bloomingdale's has reason to be bullish. The National Retail Federation estimates that 44% of consumers will do their holiday shopping at department stores this year. And Olivier Braun, he's confident it will extend his company's rebound.
It's really about rebuilding the next golden age of Bloomingdale's. We heard a lot about Bloomingdale's in the 70s, in the 80s, where it was really the place to go. And actually, right now what we're trying to build is really recreating this destination, Bloomingdale's. And we're an icon, but we have to reinvent ourselves. It's also what Josh is doing with Burberry. This is what we're aiming to do at Bloomingdale's, with one key focus is actually bringing back customer experience, customer delight in our stores, and really based on building relationship, connections, etc. This is what is making us different.
The New York retail giant joining forces with the iconic brand and plaid, a relationship that goes back decades.
This is a relationship that Burberry and Bloomingdale's have had for over 70 years. So it's the perfect place to bring our timeless British luxury brand expression to all of Burberry customers and all of Bloomingdale's customers, and frankly, to all of New York City.
To celebrate that partnership in the spirit of the holiday season, Bloomingdale's has literally wrapped their flagship store in a giant Burberry scarf.
It was a little bit emotional, I have to say, seeing this uniquely British, uniquely Burberry, uniquely Bloomingdale's story come to life on the streets of New York City. There's only one New York. We are really thrilled to open our arms and wrap a scarf around New York City and bring a little bit of warmth and joy for this holiday season.
And since Joshua Schulman took over the helm of Burberry in July 2024, shares of the London-based brand, well, they've rallied 50% as the American-born CEO leans into the brand's Britishness.
There are many luxury brands that have wonderful, beautiful heritages, and they celebrate their heritage, whether it's Italian or French. But Burberry is unique because we are the only luxury brand of scale that has a uniquely British heritage.
Burberry, remaining true to its roots, is highlighting the products that cemented its status in the luxury space, while also branching into new directions.
Everyone knows and loves a Burberry scarf, which is the perfect gift for anyone in the family, around $520. But we have a range of products. You can buy a candle for $130 to one of our iconic made in England trench coats for $3,000. Burberry has always been at its best when it is a luxury brand with broad universal appeal. What we love about Bloomingdale's is they really share our values. And this is a brand that also has broad universal appeal.
A recent report by J.P. Morgan shows that consumer demand for luxury goods in the U.S. is largely held up despite the economic headwinds. The S&P's Global Luxury Index, which tracks 80 of the biggest names in that space, including Burberry, Prada, Dior, LVMH, that is showing no sign of slowing down.
The momentum that we're saying didn't start for holiday. It started, months and years ago, and we just keep the pace right now. So we have new events, we have new marketing activation that are coming, we have new brands coming in the store right now, we have new ideas. So I think it's just a kickoff of what's coming.
And though Bloomingdale's has only just unveiled their 2025 holiday display, they're already looking ahead toward the future.
We already know what's going to happen in 2026. We're already working on what's going to happen in 2027.
That was the Bloomingdale's CEO Olivier Braun and the Burberry CEO Joshua Schulman speaking to Bloomberg's Romain Bostic ahead of the holiday shopping season, getting us in the mood for a little retail therapy. Well, coming up on the programme, the AI race heats up. Tech titans amassing multi-million-dollar war chests. That and a look at what else is making headlines on the front news of the pages. This is Bloomberg. This is Bloomberg Brief. I'm Lizzie Burden in London. Time now for your front page news. First up, on the Washington Post, one member of the West Virginia National Guard, U.S. Army Specialist Sarah Beckstrom, has died after being shot near the White House. In the wake of the shooting, President Trump said that he'll, quote, permanently pause migration from third world countries. The suspect, who's an Afghan national who previously worked with the CIA, will face multiple criminal charges. Next up, we turn to the Wall Street Journal. Billionaires and tech titans are amassing multi-million-dollar war chests for a battle over AI regulation. Donors have already committed well above $100 million. It is 5:30 a.m. in New York City. Good morning. I'm Lizzie Burden in for Vonnie Quinn with your Bloomberg Brief. Here's what you need to know. A futures outage at the Chicago Mercantile Exchange disrupts trading across global markets. Meanwhile, President Trump calls for a series of potential measures to crack down on immigration following the shooting in Washington. And the holiday shopping season kicks into high gear for retailers as consumers show signs of fatigue. Well, let's get a check-in on these markets. Happy Friday, by the way, everyone. Happy Black Friday. It is the last trading day of the month, and it was always going to be a quiet one, but it's even more quiet because of the CME outage. So in the absence of S&P E-mini futures, we've got to look at ETFs this morning. The indication, though, is that stocks are going to continue higher in today's session. Flip the board over and we can take you to what's already happened in Europe. In short, not much. The Stock 600 flat as a pancake almost. The FTSE 100 managing to eke out some gains. Euro dollar there weaker 0.25% at a 116 handle. We had French inflation unexpectedly holding steady earlier. And of course, we've got an eye on the 10-year gilt yield as traders continue to digest that UK budget. 4.45 is where we trade right now, and so we are up a basis point there. Not a lot of movement, really. But look, trading is going to resume in the US this morning. For some stocks to watch, here's Chloe Melly.
Good morning, Lizzie. Oracle is down this morning after Morgan Stanley analysts warned that a gauge of risk on Oracle's debt had reached a 3-year high, and they said that things were only going to get worse in 2026 unless Oracle manages to reassure investors that are currently quite worried about the magnitude of this AI spending spree, and therefore we are down about 1.3% for Oracle this morning. Moving on to SanDisk, which is up. It is the first day of trading on the S&P 500 for that company, and it is doing pretty well so far. A lot of that has to do, of course, with the US and Japan reportedly considering a memory chip plant in the US with SanDisk as a major investors. And finally, CME is a little bit weak this morning after, of course, that CME outage that disrupted markets across FX and commodities, and that really frustrated investors. And therefore, we are seeing a little bit of that weakness, not major, but a bit of weakness for CME Group this morning as well.
OK, thank you, Chloe Melly. Well, trading of futures and options on the Chicago Mercantile Exchange still halted this morning, as Chloe says, due to that data centre glitch. We can bring in Bloomberg's Rachel Evans for the very latest. Rachel, any updates so far?
Not yet, though. We live in hope. It's been going on for sort of 8 hours almost now, and so far we've had very little information beyond the fact that this is some kind of issue at a data centre. It seems that there is a cooling problem, whatever that might entail, and I'm sure there are people working very hard to fix it. But for now, it means that markets are largely trading in the dark. Obviously, we have kind of some of the bellwethers like oil, WTI, we're not seeing at all, but we're also not seeing kind of futures on treasuries or some of the FX futures as well. That makes it very, very hard for people to be hedging in the markets. So we're seeing kind of depressed activity as a result of that kind of across the board.
All right, Bloomberg's Rachel Evans, we thank you so much. Happy Friday to you, Rachel. Well, from that lack of data to a data leak, the Office for Budget Responsibility here in the UK is bringing in a cybersecurity expert to uncover how the details of the autumn budget were leaked early. Freya Beamish, Chief Economist at TS Lombard, writes of that budget: it was a pointless exercise in shifting borrowing to fit the forecast. The OBR tail continues to wag the dog. And Freya joins us now. Well, didn't hold back there, Freya. I take it you don't see it as a success. I was discussing this with Geoffrey Yu earlier. Are you surprised that the market is focusing so much on the headroom aspect of this budget and not really on the backloading of the fiscal consolidation?
Yeah, no, I think the government sort of painted themselves into that corner with the fiscal headroom, which is not something they actually needed to do. When we take a big step back here, the UK is actually one of the only major economies that is at least trying to consolidate the budget. I use the word consolidate rather than austerity because, unfortunately, George Osborne ruined the word austerity for everyone in the 2010s. So an actual consolidation of the budget isn't actually the worst thing for the UK economy at this point in time. It's not as though the private sector needs to deleverage. And so consolidation is just the sort of the natural thing to do at this point in time. It's just the way in which the government is trying to do it is too, actually, I would say, beholden to short-term bond market moves. And also is the wrong form of consolidation. So rather than sort of tax and spend, maybe we should think about that spending side.
I think that's really interesting because I've spoken to Rachel Reeves a number of times, and my impression is that she is so scarred by the Liz Truss experience. She knows that she's got to keep the bond vigilantes in check,
Yeah.
but you're saying that she's got them too much on the brain at the expense of a sensible budget.
Yeah, I mean, the Truss-Kwarteng debacle was not representative, I think, of what a true growth budget would look like. And she came in promising to deliver that growth budget. But when you look at the actual trajectory of government spending and the taxation that has to be raised in order to finance that government spending, what's happened is that there's been a big jump in government spending as a result of COVID. Fine, absolutely normal. But then there's a jump in all forms of government spending, and the trajectory since COVID just continues on the COVID trajectory as opposed to the previous trajectory, right? So there must be some wastage there in government spending. And if we were actually to, maybe an independent review could identify what that was, cut through some of the lobby that is now associated with that spending, bring down spending, and then actually get to the tax side of it. I don't think the bond market would mind that much. It wouldn't be their favourite thing in the world, but that would actually be beneficial to equities. Whereas at this moment in time, you're not helping the bond market, you're not helping the equity market, you're not helping the real economy.
Well, the OBR agrees with you that this budget does nothing for growth. Does that mean that more tax rises are inevitable? She wouldn't tell me that they're coming, but is the truth that they are?
Well, what happens is there's this sort of, and this is the OBR tail wagging the dog element. So you get sort of a downgrade in productivity growth, and then as a result of that, there's less fiscal headroom, and then as a result of that, the government needs to find some way of closing this so-called fiscal black hole, which is just an egregious misuse of physics. But to actually do that, they're doing that through kind of tax rises, but they don't want to do that in the short term. So what happens is they popped up the government borrowing in the short term, and then they just push all of the taxation increase, or a lot of it, into in this case, 2029.
But that's the point. Like, does the market believe that's actually going to happen when, lo and behold, we're going to have an election in that year?
Exactly. I don't think that's going to happen, and I don't think the market thinks that's going to happen. It didn't actually move so much on the day, but we already had the trial balloon, and the market had already moved as a result of the trial balloon. I think the likelihood of this kind of tax and spend policy continuing even within the Labour Party to the general election is not very high because it doesn't actually help anyone. It's not popular with anyone, and Reform is close on the heels and ready to sort of pounce on any mistakes there.
Well, look, Freya, we've got to talk about the Fed as well, because we're also looking ahead to a potential December Fed cut.
Yeah.
now priced in by the markets. If Powell pivots on so little data, would that undermine his credibility brackets further?
Right. Now, there is a theory that we've got on this, and I have to give credit to my colleague Dario Perkins. It's an interesting one. I think we had quite a clear signal in October for a normal Fed that they weren't going to cut. Wait a cycle, but not going to cut by any means. These were quite clear signals for a sort of a maestro type of a Fed chair that they weren't going to cut in December. And then we had Williams coming out and saying, actually, near term there probably is going to be a cut, which is a good indication that there is going to be a cut, right? So what's the game here? Pure speculation. Forgive me for the speculation, but I think if anything, Powell is trying to sort of undermine the chair position because he knows where it's going.
Right.
And so if you have a more Bank of England type of monetary policy setup in the US, where things are more divided, there's more of an independence in terms of what people vote on and how people vote, rather than just following the chair in a Greenspan type of a way, then that kind of chair position is somewhat diluted. I hope I haven't let the cat out of the bag there.
That is quite the theory, Freya. I also got to talk to you about this announcement from President Trump that we would talk about earlier on migration, pausing third world, quote-unquote, migration. What does that mean for the labour market?
Well, we already have quite a serious deterioration in the non-farm payrolls. Break-evens probably down to about 60, just based on the current immigration policy. Just based on if we get the detentions up to 1,200 per day, that means an NFP break-even of about 60. So already with what's in the system, we're already going to have quite a lot of supply disruption. If I don't know, how much of what Trump has said recently actually comes into practice. It could just be a sort of an on-the-day reaction type of a thing. Probably most likely that's what's going to happen. But any form of further supply disruption is going to reinforce our case for a strong inflationary problem next year. We're talking about a positive fiscal impulse that's going to benefit the middle-income section of the distribution, probably some more that's going to come through in terms of rebates benefiting the lower-income section of the distribution. We've got the Fed cutting into that re-acceleration. And against that, we've got a quite severely disrupted supply side with regard to the labour market and the goods market. So that is a recipe for inflation, to my mind.
Now, we also got to talk about the Eurozone economy, finally, Freya, because we had that French inflation data earlier this morning and Spain. Where does it leave cuts for the ECB? Which way do you see the inflation risk skewed? Is it cuts that we should be talking about, or is it actually hikes?
Yeah, I think as we go into next year, and particularly in the second half of next year, I think that sort of bias will shift more to a tightening bias. Whether that's premature or not from a macroeconomic sense, maybe, but they're always going to be focused on what is the kind of the reflationary prospect from German fiscal policy. I see that as quite a benign reflationary prospect for the bloc as a whole. I don't think that's priced into equities at this moment in time. But from the ECB's perspective, they're always going to kind of do what they perceive to be their job and protect the economy from that inflation. And from a euro standpoint, that makes us positive on the euro in the kind of the risk-on environment that we see for the first half of the year, as the communication gradually shifts towards more of a hawkish bias, protecting the economy against inflation, while you have that kind of pro-cyclical demand-led story that you have emanating from fiscal policy and probably the capex response from the private sector as well.
All right, well, great to see you, Freya. Thanks for coming in on a Friday. Freya Beamish there of TS Lombard. Now, I want to take you to some breaking news, and this is that talks for the UK to join the flagship EU Defence Fund have ended in failure. The negotiations have been ongoing. This is according to sources speaking to Bloomberg. Despite the talks between officials that have gone on this week, the two sides remaining far apart, according to these officials, on the financial contribution that the UK would have to make. And this is to stay in the Security Action for Europe programme, known as SAFE. And they've been speaking to us on condition of anonymity. But this is a €150 billion fund. It's meant to help Europe rapidly expand its military forces in the face of Russian aggression. But as we say, the talks appear to have ended in failure. So that's the latest there. But let's get you some other top stories trending on the terminal this morning. China's top diplomat has used a call with his French counterparts to say that the two sides needed to support each other, underscoring Beijing's push to win back the diplomatic backing during a spat with Japan. Wang Yi said that Japanese Prime Minister Sanae Takaichi had made provocative remarks related to Taiwan this month. French President Emmanuel Macron is due to attend a state visit to China next week. Elsewhere, Taiwanese prosecutors have searched the homes of a former TSMC executive suspected of leaking trade secrets to his new employer, Intel. TSMC has sued Lo Wei-jen, alleging high likelihood that he shared sensitive information with Intel, something that the US company denies. And Hong Kong's deadliest fire in nearly 8 decades has killed at least 128 people. The status of roughly 200 residents remains uncertain, and authorities have arrested 5 people linked to the estate's renovation project. According to the Labour Department, inspections had flagged risks well before the disaster. Well, those are some of our top stories coming up on the programme. Black Friday kicking off the holiday shopping season. Up next, how retailers are handling President Trump's sweeping tariffs. This is Bloomberg. This is Bloomberg Brief. I'm Lizzie Burden in for Vonnie Quinn in London. And it is, of course, Black Friday, the unofficial start of the holiday shopping season. And Bloomberg opinion columnist Andrea Felsted writes that this year retailers are trying to rein in discounting to cope with the impact of President Donald Trump's tariffs, while at the same time many shoppers are still under pressure and searching for the best value for money. Andrea's with us to talk about that dynamic. Andrea, it's payday. The West End awaits us. Yeah. The deal's going to be good this year.
They are. I mean, I was talking about the US in that piece that you showed. I think they're very good in Britain this year. There's been a lot of uncertainty in the run-up to the budget, so people were very cautious, and we saw that in retail sales. We also had some warm weather at times. We had a few cold snaps, but for long periods it was warm. Lots of coats and boots have got money off, and beauty is the other area where the discounts, I mean, I haven't done this systematically, but just looking at what's coming into my inbox, they look a lot deeper than last year, and a lot across the board. We've got a lot of blanket discounts, which is never a good sign.
OK, and so is it a similar story in the US?
I think in the US, the retailers are really trying to control the discounts because of tariffs. So one way, there are a couple of ways you deal with tariffs. One is you're very selective in when you put up prices. So you put up prices in the nice-to-have items, but you keep the things that people really need every day. You try and maintain price as much as possible. The other way is to be less generous with your markdowns. And that's what we've seen. I got some research and it showed that in areas that were more hit by tariffs, the discounts were still there, but they weren't quite as deep as last year in things like electronics, household appliances and toys, 3 areas that really have been hurt by tariffs.
It's like a Mexican standoff, isn't it? Who blinks first, shoppers or retailers?
Exactly.
So if it's a bad Black Friday for retailers, is it a good Black January for us, the shoppers?
Definitely, I think so. Yes, I mean, I think in Britain we have got some good deals already, and I can't see a lot of retailers going back up to full price between now and Christmas. I think in the US we're just going to have to see. Shoppers are under pressure. We'll see what they buy. What we saw in Prime Day was actually that it was a very good Prime Day, but it was because people didn't treat themselves. They bought things for back to school. They bought things for household essentials, which was, you know, showed the sort of distress they were under.
Now, going the other way, pricing upwards,
yes.
We've got to talk about the story on the terminal today about Zara. It's really a fascinating read. You basically got the heir to Zara trying to take the company in a different direction.
Exactly.
But is this going to work? Is the quality good enough to justify it?
Well, they already have been doing this for a couple of years. They've been gradually, you know, moving the range upwards. And that's a very smart thing to do because the luxury brands have raised prices so much that you've got all this white space. The aspirational luxury, particularly, you know, the not super rich, the sort of merely comfortable, a lot of those people have been priced out of luxury. So they're looking to shop somewhere else. So you've got the brands like Coach that is quite well priced, but also done a great job with Gen Z, doing very well. Ralph Lauren, which has some sort of lower, you know, more premium than super, although it has the high end too, but some of its brands are more premium. You've also got, you know, people like Cézanne doing well, filling in that white space. So this this is perfect area for Zara to go into. My issue is I don't think they've elevated the quality.
That's my point.
To match. I don't. So I went to this store when I did my piece about Zara a couple of years ago. I went to this beautiful store in just off of Sloane Square. Absolutely lovely store. But there was a jacket and had a bit of thread hanging out of it, and you know, you're asking people to pay more. You've got these beautiful stores. You can't have a jacket with a piece of thread hanging out of it. Just the simple thing you should be getting rid of.
Well, yeah, that's the thing I wanted to ask you. Are you going to still have the fast fashion, I know they don't want to call it that, but the fast fashion range and then have the high-end range all on the same floor?
I think you will, what you will do, they will still want to keep some of those prices at entry because you've got people like Shein and Temu taking more of that. But they will increase it. I think they'll segment it. So some of the new stores are really beautiful. And things like underwear, they have like their own sort of little shop for underwear, and sort of underwear that, you know, lace is very lace trim, sort of lace trim tops, things like that. You know, you can have those too in it. But this beautiful sort of area that wouldn't have looked out of place in a, you know, an upmarket store in a nice department store. So I think you'll increasingly see the store design having a bit of segmentation, but you will still have your, you know, your entry price level there because they can't afford to lose those. They can't afford to make the same mistakes as the luxury brands and lose those more, you know, entry-level shoppers.
Well, you heard it here first. Get your undies from Zara. Look, we've got to talk about Gucci as well. So, first of all, you had Kering poaching the Renault CEO, Luca De Meo, to do a turnaround. Now you've got Gucci naming a former Renault exec to be a CFO. This is the cars to fashion logic. Are they leaning too heavily into it?
It was inevitable he would make people changes. I mean, it's one of the things we've all been watching. He's already done some reshuffling. So I think this is inevitable. My own view is that Gucci and Kering, you know, as a whole, is very different from a car maker. You know, OK, you've got to do things like strengthen the balance sheet, cut costs, get the debt down. But what's different in a luxury brand is it's that creative spark that makes a difference. Yeah, so you've got to do all this while like hugging the creative so that they can do their best work and create products that people want to buy. And that's a really difficult balance. So we'll have to see whether he manages that.
All right, great to talk to you, Andrea Felsted from Bloomberg Opinion. Happy Friday. Well, coming up on the programme, we'll get you set up for your trading day, so don't go anywhere. This is Bloomberg. This is Bloomberg Brief. I'm Lizzie Burden in London. Now for a look at what's ahead today. Of course it is, have we mentioned, Black Friday, the traditional start of the US holiday shopping rush with sales to surpass $1 trillion for the first time. Plus, it's a shortened trading day with US markets closing at 1 p.m. Eastern. And speaking of which, let's get a check in on these markets, because normally we look at S&P E-minis to gauge what will happen in the trading session, but we can't because of the CME outage. So here's the ETF picture, looking pretty positive into the open. And if we flip over to what's already happening in Europe, these are thin volumes, but not a whole lot of movement on the Stock 600. The FTSE and the DAX slightly outperforming, if you can call it that, but really small moves, up 0.2% in London. You've got euro dollar on the back foot, 116 where we trade at the moment, and relief for Chancellor Rachel Reeves post-budget. Gilt yields steady. 4.45 is where we trade. But that does it for Bloomberg Brief. Surveillance is coming up next. Stay right here. This is Bloomberg.